Hey, what's up, stock compounders? Brad here. So this interview just came across my Twitter feed this morning with Francois from Giverny Capital and Leandro. Now, Leandro is somebody I've followed for quite some time on Twitter. You should definitely check him out. Invest Quotes. And you can see his pinned tweet here, this interview with Francois. I've had very little exposure to Francois, but after watching this interview, I'm very impressed. I didn't realize he had such a long track record. So he actually started investing in 1993, almost 3 decades ago. Now, check this out. The annualized returns for Francois, nearly 15%, okay? And that compares, this is sort of a weird weighted benchmark index for a number of different indexes. I looked up the S&P 500 since 1993, 9.7% annual returns, okay? So nearly 5% per year of outperformance over just about 30 years. That works out to about 3 times as much money. If you were to invest in the S&P versus investing with Francois, you'd have 3 times your money with Francois. So pretty impressive track record. You're in pretty elite company when you've managed a fund over multiple stock market crashes. You've got the dot-com bubble in here. You've got 2008. Some could argue what happened a few years ago at the beginning of the pandemic could have been a crash. So just incredible amount of wisdom picked up over nearly 3 decades in the markets. So that's some of what I want to pull out from this interview, share some of my highlights here. It's always interesting to hear how investors got started. And Francois was actually an engineer. He got his master's in engineering. So, I can relate. I didn't get a master's, but I graduated with an engineering degree as well. So I felt like I could relate on a particular level here. For a year, I read everything I could on investing and the stock market and accounting. Peter Lynch's One Up on Wall Street helped me see the light. That was kind of, the book that made everything click, One Up on Wall Street. The idea of becoming a partial owner of a business. Prior to this reading, Francois kind of saw the stock market as a gambling parlor. Okay, but after seeing, you could actually think of it as being a partial owner of businesses, which is, of course, highlighted in the Intelligent Investor as well. So from Peter Lynch, becoming a partial owner of a business, buying a company for less than it's worth, right? This idea of margin of safety. Then I read everything by Buffett. Hearing Francois really got me excited to dig deeper into this. The Berkshire Letters from 65 to 2014. Read everything by Buffett. Find great companies, buy them below intrinsic value, and hold them for many, many years. And it's really that hold them for many, many years. That's the piece people just don't get. Clearly, investor behavior in the stock market, people aren't getting that piece. People think you need to flip things as quickly as possible to make a buck in this business. But Francois learned very early on, it's really that patience that really gets us to the promised land. So that's kind of the origins of Giverny Capital. He says, Buffett and Fisher helped me realize the best thing is to find great companies, perhaps pay a little higher PE ratio than most value investors are willing to pay, and hold it for many years. Okay, that's the formula, that's the investment philosophy that he still uses at Giverny Capital. So that hasn't changed in about 30 years. Francois asked, how would you define a quality company? One very good indication that you have a quality company is a high return on equity over many years. Okay, consistently high return on equity without leverage, okay, without using a lot of debt to achieve that high return on equity, because leverage can distort the calculation of return on equity. So wants to see companies that can sustain those high returns on capital for many years. There's a reason behind those superior returns, right? When a company is able to do that, most of the time there's some kind of competitive advantage. So our job as investors is to identify what is that competitive advantage. Is it durable? Is it, fragile? What is the nature of that competitive advantage? He says usually there's great people behind a business with a competitive advantage. So it behooves us to really understand the culture and the people that kind of brought that business, elevated that business through the execution on those competitive advantages. He says the ideal example is Fastenal 30 years ago. This isn't a company I'm familiar with, but he gives a few kind of highlights about why this is a great example. It was managed by the founder, who owned 25% of the shares. So clearly a lot of alignment between the founder, the CEO, and the shareholders. This founder was paid $100,000 a year with no stock options. Okay? Reminds me of someone. Here's the non-ideal situation. When managers are paid a lot of money in salary and don't have a big ownership stake. They're not rewarded exactly in line with how the shareholders are rewarded. So these managers can be rewarded without shareholders getting superior returns. That's a tricky situation where the incentives of management, perhaps if you're collecting a high paycheck, as a manager, maybe, certainly if you're incentivized with bonuses to hit certain short-term targets, you can make short-term decisions that jeopardize the long-term growth of the business. Or maybe your sole, objective as a manager is to keep the business alive, because then you can keep collecting your paycheck. Now, from a shareholder's perspective, I certainly don't want companies I'm invested in to be focused on staying alive, right? I'm looking for that growth, that powerful compounding over time. So ideally, you want a CEO with a good percentage ownership of the business, right? Now, there's been situations that Francois has seen where the managers didn't have a lot of shares in the company. They didn't have a lot of skin in the game, so to speak, but they did an incredible job over many years. Okay, so that does happen. That's probably more the exception than the rule when you have that kind of misalignment of incentives at the management level versus shareholders. One great quality that is needed for a CEO, okay? The most important quality is capital allocation, okay? You want a manager with superior capital allocation skills. If you're going to own a company for 10 years, a big part of your return will be linked to how yearly profits are reinvested, right? How those profits are deployed. Acquisitions, buybacks, dividends, developing new products, right? These are all examples of ways that earnings can be redeployed. So this is a fantastic article. I think Leandro actually mentioned this one. Capital Allocation by Mauboussin. And it's 85 pages just digging into what is capital allocation, what are the considerations, how do you weigh where to actually put the capital as a manager. It's a master class in capital allocation. And you can see here there's a lot of different places to put capital as a manager. Mergers, acquisitions, right? Capital expenditures, research and development, divestitures, dividends, share buybacks. There are so many options. And usually when a manager rises to the role of CEO, they didn't rise because of their exceptional capital allocation skills. They rose because they're really good at managing people. And so it's a skill set that not a lot of people who rise to the level of CEO already have. It's usually something that has to be learned. And so this is really something to pay attention to in companies that you invest in. What is the skill set for the management team around capital allocation? Let's see. Capital allocation has to make sense in terms of building a culture and increasing the moat of a business, the moat around a business. I really appreciated this point. So Francois talks about tech companies, right? Tech companies are all the rage for investors these days. Obviously, they're sexy. They tend to have a lot of growth, which can work out incredibly well for investors. What tech companies can lack is durability. And here's what Francois says about this. There are very few tech companies that have been able to sustain a competitive advantage over decades. If you look at history, there are very few tech companies that have been able to be leaders and sustain their competitive advantages for a long time. It's tough because it changes so rapidly, right? Like when you're operating in an industry with rapid change, it's just very tough to survive. Especially, as you get bigger, often you become less agile. And when the next big disruption comes along, which in tech comes along fairly frequently, it can be very difficult to survive that. If you miss a turn somewhere, you can be cast out of the market very rapidly. There are many companies I purchased 25 years ago that don't exist anymore. So I've learned from that, right? Hard lessons. Francois has learned to really think about how long are these companies going to be around? Are they going to be in the portfolio long enough to be able to, benefit us as investors in terms of compounding that capital? So it's a difficult industry for Francois to find compelling ideas. The moat for any company is always shrinking or expanding. Okay, there's no companies with a static moat, just fixed. It's either getting stronger or it's getting weaker. So as investors, we need to find where the moat is expanding and avoid those companies where the moat is receding or shrinking. He talks about capital allocation, right? How much does he put into a new idea? Does he trim if a company gets too large in relation to the total portfolio? He says in his younger years, he was more aggressive in terms of putting more sooner into a new idea. These days, because he's seen his share of disappointments, he's more prudent. Francois will usually start with a 1 to 2% position in a new investment. Okay, 1 to 2%. of the total assets under management he'll put in. He'll increase it as he gets more confidence in that company, in that investment decision. The goal is to have 20 to 25 names at around 4%. He says the most I'll invest at cost is 4%. Okay? So, I've spent a lot of time looking at Monish Pabrai's portfolio, listening to his talks. He likes 10%. Okay, so Francois is considerably, significantly more conservative than Pabrai in that regard. Probably more like how Guy Spear would approach a new investment. We have the attitude of letting our winners run. So the next thing he says is kind of interesting to hold in the same breath as that. Once it reaches 10%, we'll trim it. Okay? So that's something I haven't heard many investors talk about. Although, I think of Nick Sleep, who let Amazon become like, I think 60% of the portfolio or something like that. Maybe even 70%. So, this is very different from that. But he gives examples, at least one example here, of how that has benefited him. So that's a learning point. But if we look at his current portfolio, at least as of the end of last year, you can kind of see, we know anything over 4% has grown to kind of be that size. So Visa, Google, Heiko, CarMax, Markel, Berkshire, these have all kind of grown to be bigger than that initial investment. Anything under 4%, he's either still building or maybe it's just gone down in the market, right? The market price has gone down since he's invested, or he's building, or he's just not sure, right? He's got a lot of positions in here, certainly not 20 to 25. He has 66 holdings, okay? Now, towards the bottom, when you get down to less than 0.1%, I mean, I'm guessing that's really just, so he pays attention to it. It's kind of a bookmark. But it's particularly interesting to look at these positions kind of around that 1 or 2% that he likes to put in as an initial position. Particularly Fortune Brands Innovations, which he increased 41% in the fourth quarter. It's getting close to a full position size. And then Lululemon, again, it's above a starter position. He nearly doubled it in the fourth quarter. So those could be two companies to look at. If you really jive with Francois' investment approach, those could be interesting to kind of try to look through his lenses from past talks, his framework for investing, and try to get a sense, okay, what is he seeing here? And is that compelling for you as an investor? So just a quick peek at his portfolio. I notice Floor & Decor, which I'm pretty sure I've seen in the Berkshire Hathaway portfolio. So yeah, get some ideas from this here at TIKR Terminal. And I believe he's located in Canada. I'm pretty sure he's in Canada. But he seems to really be focused on U.S. companies, which is interesting. It's much slimmer pickings in Canada. I think if you're not really focused in the mining sector, but notice that as well. Okay, a few more points I want to get into. Right, once it reaches 10%, we'll trim it. He talks about why he wants 20 to 25 positions, at least kind of making up the bulk of the capital in the portfolio. Once you get to 50 to 60 names, I think it's very hard to beat the index. Okay, you're over diversified. So he's shooting for about half that. Okay, he talks about his mistakes, which is great. I love when investors talk about their mistakes because there's so much to learn from those. So the first one he talks about is Valiant. He says Valiant was a big mistake, nowhere near the biggest mistake. He says we were lucky with Valiant because we probably doubled our money over 4 or 5 years. So that's pretty fantastic when you can get 15% annualized returns, which is what Francois's 30-year average is on a mistake. But here's why he was able to get that double. It's because of this rule, trimming when it gets to 10%. More about the mistake. They made a bad acquisition and had taken on a lot of debt. Okay, so that was really when Francois cut his losses. I'll say why he cut his losses, but he still doubled his money. He says, I knew the risk in Valiant was a little higher than the other investments in the portfolio, so I capped that investment at 5% instead of 10%. We trimmed a few times in the first few years, right, when Valiant was making pretty aggressive gains in the market. The mistake was in the judgment of the quality of the CEO. He was just too aggressive. And this makes me think of Carvana, right? I was listening to Rob Vinal's post-mortem on Carvana. And he was talking about how, they probably just tried to do too much too fast. And there wasn't enough patience. And that seems to have been the situation with Valiant as well. Too much debt, pushing too fast to grow the business. And tripped and fell. And because they were trying to go too fast with too much debt, the fall was fatal. So the more interesting mistake that he talks about, much more interesting to me. This is something that you hear Charlie and Warren talk about it a little bit, but I don't hear many other investors talk about this. The real big mistakes are when you find a company that really fits your criteria and you don't buy it for some simplistic reason. This reminds me of the Belridge Oil mistake that Charlie Munger made in 1977. He bought a certain number of shares. A few days later, he was offered like 4 or 5 times the number of shares, where Charlie didn't have the cash. He would have had to sell something to make that investment. And, I guess he thought the CEO was an alcoholic, and that gave him pause. But it sounds like that fits into this mistake, right? The value of the oil field for Belridge Oil was clear. And to put so much weight on the CEO being an alcoholic, Charlie clearly saw that as a mistake. Back to this, you don't buy it for some simplistic reason, like it's a little too pricey, right? Maybe it's 20 times earnings versus 15 or 10 times earnings. That's kind of where Francois is going here. Then the stock increases 1,000% over 10 years or 2,000% over 15 years. When you miss a 2,000% investment because of some stupid reason, that's a much bigger error than the stock that you buy that you lose 50% on, okay? And I just want to quantify this. So let's say you put $1 million into a stock. It goes down 50%, right? So you lose $500,000. Now, let's say you would have put $1 million into an investment, right? It was in your wheelhouse. And because you didn't, it went up 20 times. So instead of the first case where you lose $500,000, in this case, you're losing 20 million. Okay? That 20 million would have made up for 40 of those first mistakes, right? Of losing half your money in a company on an investment. So obviously a much more massive mistake, but most investors, I think, just don't think about it that way. And I appreciate Francois' perspective on that. I guess in his letters, in Francois' annual letters to his investors, he gives out medals for mistakes, right? I guess he wants to, in a sense, reward mistakes because, hey, mistakes are part of this business. And it's not really a mistake if you get the lesson, right? The lesson is so much more valuable, especially if you have a lot more years ahead as an investor than the mistake actually cost you. But he says of the 60 medals I've given in my letters for mistakes, probably 55 are mistakes of omission, where the investment should have been made. It checked all the boxes. There was just some kind of silly reason for taking a pass on it. 55 out of 60 mistakes are of that nature. He says one that comes to mind is Copart. It's a fantastic company. I knew the company. I read the book that the founder wrote. He knew it was a great business. Okay, it was just a little too expensive on a price to earnings basis, and he took a pass. And he's given up, a multi-bagger because of that. Which is interesting. I wonder how he feels about Copart now. I was just looking at John Huber's Sabre Capital Management 13F, and I think he increased his Copart holding by like 60% or something. Pretty significant increase to the Copart holding. And it's 23 times earnings right now, something like that. That might be an EV to EBIT. Maybe it's 30 times earnings. But, I'm curious if that ship has sailed for Francois. I assume Copart is still on his watch list and he's kind of got a target of when he'd buy into it, but I don't know. All right, last piece here. The key is to hold on to the ones that do well, okay? Let the winners ride. Trim if you must, but keep them in the portfolio. And probably as fast as you can, sell those where things didn't go as planned. Okay? If you have an investment where, the surprises keep ending up on the downside, right? There's just mistake after mistake. Probably a sign that it's just not, either it doesn't have the moat that you thought it did, or the management team just doesn't have, isn't as skilled as you'd like them to be. If it smells fishy, Francois seems to be saying, probably as fast as you can, just get rid of it, cut your losses, and move on to something that surprises you consistently on the upside. Okay, that's really what we're looking for. The trap is to sell great companies when the price to earnings ratio looks a bit high. And Pabrai talks about this a lot, right? Don't sell a business just because it looks expensive. Wait until it's egregiously expensive, right? Maybe 80 times earnings, 100 times earnings, something egregious. Charlie talks about how, Costco is expensive right now. I think it's like 40 times earnings. But Charlie has no intention of selling Costco at 40 times earnings. He wouldn't buy it here, but he understands. Charlie understands. These great businesses don't come along very often. And if you're planning to hold them for decades, just because they're a little bit expensive right now, and you think you can be smart and sell it and maybe get back in when it's cheaper, it may never get cheaper, right? And you may miss out on decades of incredible growth. And that's really the holy grail for investors, is just to hitch our wagons to those incredible businesses for decades. That's where the magic happens. So be reluctant to sell the investments that are doing very well. Okay. Don't try to outsmart your portfolio by selling at what you think is the top. Pabrai has talked about that's why index funds, one of the reasons index funds tend to do so well, they're too dumb to sell Microsoft when it looks expensive, right? They just blindly hold the 500, right? Talking about the S&P 500, the 500 biggest companies in the US, blindly hold them until they've exhibited so much incompetence that they just fall out of the S&P eventually. But there's, it's that passive approach, that owner mentality. When you have a great business, that's really the key. Anyway, guys, I just want to make sure I've covered. Yeah. So Leandro, give Leandro a follow. Awesome resource on Twitter. We've looked at these. That's all I have to share from this one, guys. So thanks for watching, and I will see you all in the next one. Take care.